Ladies and gentlemen of the crypto space, we're live at a Friday, December 19th at 11:15 a.m. This can be a short stream, but a good topic. 2 points came to my mind this morning. It's culminated in the title of the stream. Title of the stream being most folks look to the wrong signals and therefore see the market completely backwards. Maybe it doesn't entirely encapsulate what I was thinking, but there's 2 points. 2 points with regard to signals. One, the most important thing isn't the Fed, isn't even the United States. The United States has only printed a small part, a little bit over 10% of the amount of dollars in existence. And that's probably the hardest thing for most people to grasp. They don't understand that if you borrow money from a bank in England, it's not like they're lending you dollars that they got from the Fed or actual dollars. They're crediting your account that they owe you dollars. And if you withdraw $10 at an ATM, even though you're all right, whatever, you're borrowing dollars, you have a dollar deposit in an account and you withdraw dollar bills, um, they have to acquire dollars. So, but most people don't withdraw cash. So the point is, you do a wire transfer, you do a credit card transaction, and you pay a credit card bill. The bank never needed any dollars. They didn't need actual dollars. So there was a dollar liability. The bank owed you a dollar. So the bank transfers that dollar liability to the credit card through the ACH to another account. So that's the way the vast majority of dollars in existence have been created. And there's over 300 trillion of these dollars in existence around the world. And the United States has only printed a small part of that dollar currency supply. This is called the Eurodollar banking system and the fractional reserve banking system. Now, without understanding that, you get lost in the noise. You get lost in, oh, the Fed's going to cut interest rates and have paid no attention whatsoever to Lynn Alden's fiscal dominance and how Luke Gromen talks about financial conditions in the markets, even though I don't agree exactly where his mindset is, because I look very specifically to just global currency supply. And I understand a very simple principle of human psychology. If there's more money in the system and the system has a capacity to lend more money, then things go up in price. And what goes up in price? The things that are easiest to purchase, the things that are most liquid, things that are most speculative, the things that are going up in price tend to go up in price the most. Okay. And then we also have other narrative considerations like the system needs a bubble. And we've talked about that. They're not going to get into real estate or the stock market. So I won't digress into that. Um, so for that, we look to the move indicator and it's crashing. This is something I've talked about for some years at this point. Why? Because it's literally taken years. Peep the red box. It has literally taken years to get back into the purple box of normalcy, which is more in line with maybe an average price or an average value on this chart over the last 15 years, dating back to 2010, where we start to get below this green level. So obviously in the green box was normalcy heading into 2020. So, maybe we're probably at about normal. Look at that. It's right halfway between the box, which is the lows here and this green level. So this is probably an average value. This is normal monetary conditions because the global monetary system uses bonds as money. Okay. Not this talking point of what is money and what is hard money and what is gold. Gold is money and everything else is currency. Yeah, okay, so that's part of the conversation, but the world uses bonds as money, and the largest supply of bonds is the United States bonds, and that's what it uses as money. That's what the world uses as money. So stop getting yourself confused by listening to talking points like, "Oh, it's not good money," but that's what the world uses as money. Okay, so that's what the way the global monetary system has printed the vast majority of dollars in existence using United States debt as money. It's the status quo. Accept what is and understand what is to understand how the system works. Um, What was my other thought? I had two thoughts. So I wanted to. Oh, okay. So there's two thoughts. So bonds is money. Eurodollar system. Move is finally rolling over. Move rolling over, in my view, is a forward-looking indicator of global currency supply expansion. Under normal monetary conditions, if everything is quiet, everything is cool, calm, and collected, the banks have slowly accumulated assets. They probably have to sell liabilities in order to balance their double entry accounting books, and they want collateral. So that means they want to lend, and they need bonds. So bonds get bid. Maybe prior to 2008, it was a little different. They didn't need as much collateral, but now they do. So bonds get bid using currency swaps so that people use foreign currency to swap the dollars, to buy the bonds, to use the bonds as collateral, to take out leveraged loans. And so interest rates come down on the long end, and we don't really see that right now. We're still hovering at around 4%, but move might be the forward looking indicator telling us that in the next quarter, long end interest rates roll over, which means the bonds are getting bid because they're going to be used to increase global currency supply, the collateral that the Eurodollar banking system needs in order to print the currency that it historically does. DXY is still hovering at a little less than 100, 98, 99. So we're not seeing the moves that we really want to see to solidify where things are heading, but things are certainly in a better condition than they were last year and the year before. They're certainly in the best condition they've been in since 2022. And it was very tough in 2022. Why? Because bond volatility was high. The money in the system, the volatility of the money in the system was high. Therefore, there was a significantly less there was significantly less capacity for the system to print currency from the money supply. Okay, so now we're finally, and it's only a couple of months. There's only like 2, 3 months here. They're finally getting into this territory where the money supply is turning into, or it's reorienting itself into a state where there is a capacity for the system to significantly increase currency supply, coming from not having that capacity. So that's why it's a forward-looking indicator. Takes time for the system to adjust, like, oh, for the last couple of years we're not lending, we're not lending. Oh, everything's calming down a little bit. All right, hey, bankers, go out there, see what people want, see what appetite there is. Oh, you need what kind of discount, what kind of deal, what kind of program. All right, fine, have it. So that's what my expectation is in the coming 1 to 2 quarters. Financial conditions warrant the banks selling liabilities, and they have their underwriting where they have to, or they are required to take on particular forms of collateral. So that's why the long end comes down, and that's why the banks force the increase in currency supply, because they have their mandates. They have to sell the liabilities in order to balance their double entry accounting books. Okay, so I hope that explains where we are with regard to what I look for in macroeconomic indicators. Most people are looking at fucking Bitcoin and RSI, and no, that's not going to tell you where Bitcoin's going. It's not going to tell you anything. Oh, the sentiment. Oh, oh, hardest money in the world. Oh, people are they have well, no. I mean, gold probably pierces through all the bullshit narrative more than anything. This is just excess currency. The manifestation of anything other than any of the perversions of the financial markets is really because of excess currency supply. So really the entire notion that crypto exists is because of excess currency supply. If we had super duper hard dollar money instead of dollar currency, so to speak, crypto wouldn't be. And that's we didn't have crypto 30 years ago, 40 years ago, 50 years ago. The dollar was significantly more valuable, increased purchasing power. This wasn't even on the minds of people. It wasn't needed. But in this age of significant abundance of currency supply, these are the things that emerge. This is the way the world is now. We process and manage financials considering the way things are, not the way the things, not the way we want things to be. All right. So looking at Bitcoin price is merely noise. And that leads me to the second thought I had. The biggest mistake people, in my opinion, the way I want to manage money and the way I've accepted the realities of capital management for myself, my family, and so on and so forth, is that people think they're in control over their net worth. And that is a statement that may be hard to digest for a lot of people. But for me, that's how I define it. I am not in control over my net worth. My net worth is a manifestation of economic conditions, interest in the assets that I own, interest in the assets that I've chosen. So if you take that to the extent of where my mind heads, I have no control. I have no power. I'm just an observer. So what do I have control over? I have control over and a responsibility to execute very slow moving, very infrequent adjustments to the overall portfolio construct. It's like a sculptor or an artist or a painter, some slow, methodical adjustments, very few adjustments here and there. And then I'm at the mercy of markets. And that's okay because that's the way I understand markets. All I need to do in order to be financially successful is own the things that I deem more likely than less likely to be successful in the future based on my understanding of global economics, which I literally started the entire stream talking about for the last 15 minutes. Based on that entire understanding of the intro of the Eurodollar market and how currency is printed for money and bonds are money and US treasuries are money. That's based on the things that I have chosen, the things that I own. That is my future. That is my total net worth. And I have no control over that net worth. The market will tell me what the things that I own are worth. Right? Not only it's not accept that just is. You understand? Like acceptance is like a defeat. There's no defeat in the way I see my methodology. There's not comfort, but there's reassurance. Like this is right. This is a position of comfort, a position of nobody does it like this, and that's why I'm right. And that's not for anyone else to. I don't need validation. It's just me coming to that conclusion, and I will receive. The market will provide all the validation I need, and I think it'll provide it sooner rather than later, based on current market conditions, the way I see them. I mean, for all things considered. Come on, look at the volatility we've had this week and people pissing their pants, hundreds of millions of dollars worth of liquidations, and Bitcoin's in the green. It's in the green for the week. Everyone losing all their money with those stupid longs and shorts and all the sentiment and fear and oh, the Bitcoin's over, the party's it's in the green for the week. Week over week, Bitcoin's in the green. It means everyone is just wasting all of that mental effort, all of that emotion, all of that statements and talking points and rhetoric they throw around on social media. It's a waste. It might not end in the green, but it's basically a doji right about now. Spinning top. Just look at it. It's green for the week. The people just waste their time and the effort. That's it. Waste, waste. What a waste. Just rewatch this stream and listen to how I see money, and then come to the conclusion you're not in control. And the money is going to do its thing, and then your portfolio is going to do its thing. So you're reduced to a spectator after you're an artist. Okay? If that makes any sense. Hope that helps, ladies and gentlemen. Curve at 35 cents. Hammered. Yeah, fine. Smash burger. Yield basis down below 40 cents. Convex 170. Aerodrome less than 50. All right, so everything's getting hammered. Ethereum will outperform to the upside 5.51% on the day. EPTC, decent inverse head and shoulders. Decent. I mean, that's not the biggest shoulder. That's decent. Dominance. Dominance. All right. So there's, I mean, a moving average on a dominance indicator, but fuck, it's literally holding at a support. That's very clear. Independent of whether you see a moving average on a dominance indicator as significant, it's literally expressing support on it. So it is what it is. Interesting. Some big wicks to the upside, pushing the 50 SMA on the weekly. But thus far, it's pinched between the 50 and the 100. You got resistance above, support below. This looks like a topping pattern. This looks like maybe a loose head and shoulders. And then you go on ETH BTC and you got a loose inverted head and shoulders. I would just call it confluence and say everything looks good, especially with the macroeconomic conditions, with the move rolling over to the 60s, and with Bitcoin coming in above the weekly 100, green on the week. Everything looks good to me. Net worth is down. Should I be looking at it? No. Am I in control over it? No. Does it affect me? No, because of rule number four. I'm performing or executing according to the rules the best I can. John, rule number four has served me well. Don't forget about rule number four. Let's go through commentary. We'll keep it short and sweet today. Arrow, good morning, my friend. How are you? Alessandro, good morning. A pleasure. Gamer, game runner. Good morning, Cap. In a while. Could watch live. Appreciate you. Much a pleasure. We're here. The stories will continue. Good morning, Gang Fugu. Brian, happy Friday. Scorpius, hola, Capitan. Much a pleasure. What kind of time lag do you expect regardless ability currency expansion? Yeah, that's a relatively straightforward expectation for as a forward-looking indicator, a quarter or two. So I do chunks of time. I think in very long-term time horizons. So I'm not going to break down the year into halves. So let's say a quarter or two, 3 to 6 months. So sometime early 2026. I mean, you wouldn't have move rolling over like this. Move doesn't just roll over. This is geopolitical collusion executing at its finest, and it's a cyclical thing. And we haven't had. This is just this. What we experienced between 22 and 25 is volatility in the global money supply unlike anything since the great financial crisis spanning 2000 end of 2007 to 2012. Come on, it's all right there in the chart. And I know folks just don't get it the way I do, but it makes sense. It makes sense if US debt prints dollars and it's volatile, just think of it in terms of Aave. If you've never used Aave, you're not going to understand what I'm trying to describe. But if you have, and if you've borrowed money against collateral, you understand the significance of the volatility of that collateral. Very straightforward thing. Causality is very straightforward, in my opinion. Listen, if the collateral is, if you're going 10% in a day, up and down, left and right, you're not going to borrow money. You're not going to know whether you're going to be conservative. You're not going to know whether you're going to get liquidated or not. And in crypto, it's permissionless. So that's you as a borrower. In meat space, the banks, you have underwriting and their risk profile because they're under collateralized fractional reserve. So their lending is significantly restricted if there's a lot of volatility. They don't want to caught. They don't want to get caught taking on collateral that has a shitty interest rate. If interest rates or if interest rates are going to roll over, maybe they want to lock in the higher interest rate, so they take on higher valued or higher interest rate collateral. So you can imagine what goes on in the minds of underwriters. But with volatility high, you got interest rates going up and down, and you got the face value going up and down. Well, not face value, but fair market value going up and down. So it makes things very indecisive. You can't make decisions, and it freezes the entire global currency printing process. But now look at the 60. I mean, look at the interest rates. Look at 10-year interest rates. Oh, there's big volatility, obviously, between 20 since you broke. the 200 SMA and the weekly to the upside. That's massive volatility. But the volatility between the 24 and 25, you're talking about 5% and 4%, 1% volatility as compared to going from 5% from 0.34% over the preceding 3 years. So after 2024, the volatility significantly decreased, like this. This volatility as a 1,400. And if you go like this, you're talking about, I don't know, fine. So you got 14 plus X to the upside and 30% to the downside. It's a significantly different amount of volatility, significantly different ranges. Come on, guys. So you can imagine the underwriters are like, all right, fine. Now we can make some decisions because the volatility is finally coming down. It's not even like it's coming down. It's crashing. That's a monumental crash. We are, it's like April of 2012 or post. So, so here's the deal. April of 2012, and then you had what? This is Asian currency crisis, or macro folks would be able to better describe these types of events. I don't know them off the top of my head, but this is coming off the heels of the great financial crisis. Um, it took years for that volatility to finally come down. And then all their QE programs, they suppressed the volatility. You had your blowout with the repo crisis in September of 2019, and the greatest financial intervention in history. And they finally got it under control a month later. And so we're here, and we're here, in my opinion. And I mean, come on, if we're here, what was going on in March of 2017? Fucking raging crypto bull market was going on. That was the 16-17 cycle. Okay, crypto didn't roll over until 2018. And what happened in 2018? January 2018. Oh, the move spiked right into the 200 SMA on the weekly. This was a monumental spike back then. 2018, 17. You find so it took some years between 15 and the 14 to finally roll over and get some relief and allow the money supply to calm down. And then you had a big rip to the upside. Look, you had these big gaps, and that scared the crap out of people. And then 18 and 19, it was just doldrums. And then it finally broke May of 19. And that's when it was capitulation, final capitulation heading into 2020. Uh, Folks don't remember 2019. There was nothing. It was literally like right about now. That the sentiment was just there's nothing here in crypto. There's nothing for anyone. And then the break into 2020, which I've gone over the story. I'm not going to start that right now. But that's where we are, in my opinion. Finally rolling over. Okay. Hope that helps, ladies and gentlemen. Keep calm, carry on. Stop looking at the headlines. Look at the macroeconomic data, the DXY, the move indicator, and 10-year yields. When you see all three of them go down, DXY, move, and 10-year yields, things are heading in a constructive direction. My expectation generally is Bitcoin holds the 100 SMA in the weekly. Maybe you get another wick down. I don't think we're heading towards the 200, which should be 56,000. I think we hold the 100 SMA and we have significant volatility. I mean, that's literally like 80. See 80 grand? All right, fine. Which is 10% to the downside. Whoopie do. You see big wicks. I mean, look at these deviations. Where's March of 2020, which was like nothing in hindsight. March of 2020. Things started rolling over in February, and it was 63 days, 2 months for complete recovery. 2 months, a month, and then we're here, which is literally an entire different chart. Can you imagine what we've been through? So you have deviations to the downside. Not that I'm expecting systemic intervention from monetary authorities or fiscal authorities, but I don't expect prolonged deviations to the downside, even if we have a disruption in global financials. I like this 100 SMA in the weekly. I think it looks good. Ryan, present, much a pleasure. How about that move indicator? Yep, yep. That's the story for today. Ladies and gentlemen, we'll keep it short and sweet today. Move at 60 is a nice way to end the stream. Friday, December 19th at 11:40 a.m. We are quickly approaching the end of the year. We are quickly approaching Christmas, Hanukkah, holiday season. Pick your customs, what have you. Be good to your friends, be good to your family. Take care of your family. Take some time off, and remember the 2 points of today. Um, Social media will drive you nuts. The volatility in crypto assets will drive folks nuts. Most of what people look at in social media is just a waste of time and effort. Most of the technicals is meaningless, but I look at technicals and I just look at them in a way that's constructive and consistent with my worldview. And the other point of today was that you are not in control. And if you think you're in control, then you're trying to force the portfolio value to be something. I don't do that, nor do I advocate that from a financial management perspective. You want to own the things that will change the system. It's like roulette, but it's more than roulette because that's just a random number. There's so much information, and it's all our stories over the last years of what is what makes perfect sense to change the way things are. All these businesses, these B2B crypto businesses we've identified, the 5 businesses of crypto, they change things. I stand by that, and I have banked my family's future on that, and I sleep well at night. I wish you all a wonderful weekend. I will see you guys and gals next week, maybe in limit capacity, depending on a variety of things, but otherwise, be well. 88 people made it to the end of the stream and are now all that much more rational because of it. Thank you all for joining. See you guys and gals later.